Hello, everybody. Ed Yardeni here. Well, we've had a nice autumn. It's a little cloudy today, but all in all, a nice day. This afternoon, I'm going to have to cover up. We have a little fountain in the backyard, so I'm going to cover that up. So like the squirrels running around out there, things to do before the winter comes. I suppose some of you live in places where you don't get winter or you don't get snow. So I hope you're enjoying that. I like the four seasons, as I mentioned before. Lots to talk about. Certainly, there's always lots to talk about in our business. Never a dull moment. Already had one question, so we know that the questions platform is working. I wrote this morning about the Great Monetary Reversal, GMR. The Great Monetary Reversal is really been quite extraordinary. We've come off a long period where interest rates were near zero, where we had quantitative easing programs, and central bankers were fighting what they thought was deflationary forces. Remember, it wasn't too long ago that the main central bankers' goal was to get inflation up to 2%. They couldn't understand why, with all that easy money, all that zero interest rates, negative interest rates, quantitative easing, why they couldn't get inflation up to 2%. I think there were a lot of very powerful forces at work that were inherently deflationary. And so the central banks responded to those forces by providing very, very easy money. Of course, with the pandemic and the combination of ultra easy monetary policy and very stimulative fiscal policy, particularly here in the United States, plus a run of bad luck. I don't know that we call a war in Ukraine is bad luck, but it's bad, that's for sure. Then we had issues in commodity markets even before the Ukraine war. But all in all, we've had something that feels kind of like the 1970s on speed. It's kind of like watching the 1970s on fast forward. Now what we're seeing is what feels like the tail end of the 1970s, where the Fed has said that they are basically embracing Volcker 2.0. Fed officials, including Fed Chair Jerome Powell, have said that they want to raise interest rates until they see clear signs that inflation is moderating. Now that's clearly what we saw under Volcker 2.0. Under Volcker, so this would be Volcker 2.0. Then on Friday, we had the hint of maybe they were going to dial that back and start to talk about Volcker 1.5. Of course, they're not using that kind of terminology, but I think it kind of helps to explain their thought process. So it seems like they may very well be moving from let's go for it, gun it, raise interest rates, scare the living daylights out of everybody, get interest rates to go up quickly and bring inflation down. Well, on Friday, we had the article in the Wall Street Journal suggesting that, or reminding us that some Fed officials have already been suggesting that maybe they need to tone it down or moderate Volcker 2.0 to Volcker 1.5. The idea being that they will proceed with the 75 basis point hike in the Fed funds rate on next week. How time flies. And then the thought in the markets, so what was discounted in the market, was that there'd be another 75 basis points in December, and then further rate increases, though not 75, maybe 25 to 50 basis points early next year. That seemed to be what increasingly the markets were discounting. But now I think we're getting some guidance from the Fed here. We had Mary Daly saying that they need to step down. I don't know that she's the most influential of Fed officials, but she certainly has been in sync with the party line, with the official stance, and now she is maybe taking a step away from it. Jim Bullard of the St. Louis Fed about a week ago said that he'd be in favor of 75, and then pausing. So we're getting some nuances here on what they might do in December. I think they're going to do 75 upcoming, and I think they'll do 75 in December, and I think they will try to moderate that 150 basis point increase by along the way saying that they will consider pausing next year because after all, and with that kind of 150 basis points plus the 300 they've done since March, we're talking about 450 basis points in the Fed funds rate just since March, in less than a year. That's really quite an extraordinary tightening of monetary policy. And as I've said before, I think they're not even factoring in that QT2, quantitative tightening, certainly has some equivalence to raising the Fed funds rate by at least 50 basis points. And the surging dollar, I think that too has sort of an equivalence of at least 50 basis points. So I think we're basically talking about 450 basis points on the Fed funds rate, actual Fed funds rate, and another 100 basis points in effective Fed funds rate tightening. 550 basis points is massive. And one area where we can see it having an immediate impact is in the mortgage market, where the mortgage rate has gone from 3% at the beginning of the year to over 7%. And we're seeing just a free fall in mortgage applications. People just can't afford to buy a house. And so far, we're actually not seeing in the macro data that home prices are taking a dive. Anecdotally, we're hearing that in order to sell a house, sellers have to cut their price substantially, but we're not seeing that just yet. Maybe it has to do with the mix of houses they're selling. It's conceivable that people with means that can afford to spend bucks can afford to spend money on more expensive homes are doing it, and people without means are basically priced out of the market and being forced to rent. So there could be sort of a distributional aspect to what's going on here. But I think the free fall in mortgage applications is clearly starting to be visible in housing starts, single family housing starts. Multifamilies are holding up quite well. And that in turn, I think will lead to lower prices. So there's also a big negative wealth effect that's occurring here, much to all of our chagrin, obviously. The bond portfolios are down at least 25%, if not 30%, maybe even more than that in some instances since the beginning of the year. Equity portfolios, well, if you look at the S&P 500, we're down about 20%. We had been down as much as 21%. We had been down as much as 24%. So that's a big negative wealth effect. Put that all together, and the Fed really has slammed on the brakes here. And we already have what I describe as a rolling recession that's rolling through housing. The auto market, you probably have seen some articles already indicating that now that parts are becoming more available and the auto industry can produce more cars and deliver them to the showrooms of dealers, they're starting to find that people just aren't able to afford a car with what's going on with interest rates, or lending standards have tightened up quite a bit. So loan availability of loans is getting to be tougher. And then, as we know, for the past few months, retailers have suddenly discovered that maybe they over-ordered. Remember all those ships that couldn't get into the ports? Well, they've been getting in. The products have been delivered just as consumers seem to be saying that no mas, that they've bought enough in consumer durable goods and other goods so that the retailers have been stuck with inventories, have had to discount them, which is what they do in recessionary environments. And yet, the Atlanta Fed's tracking model for real GDP shows real GDP increasing by almost 3% during the third quarter. And so something is offsetting these recessions that are rolling through housing, through autos, through retailers. And by the way, the retailers includes people not buying PCs, not buying flat screen TVs, because they already did it during the pandemic, which in turn has had a depressing impact on semiconductors because they don't need semiconductors. Producers don't need semiconductors to make TVs and other electronics that people don't want. But the service economy is still doing quite well. We saw that in the non-manufacturing purchasing managers index for October. The economy is certainly, I think, getting a lift from onshoring. We've seen the fiscal authorities contribute to onshoring by saying that they're going to spend some serious bucks to bring semiconductor production back here to the U.S. I suspect we'll see some of that going on also with other technologies like lithium batteries and so on. There are plants being built, export facilities being built for liquid natural gas here and in Europe. Clearly, Europeans can no longer depend on and no longer want to depend on Russian gas and energy. So the U.S. is becoming a big global swing producer. As Jamie Dimon recently said that he thinks that the U.S. is the swing producer in the oil market, not Saudi Arabia. And I kind of agree with that. I'm doing some work for tomorrow on U.S. Production and usage of petroleum. And our net exports are down to like minus 2.4 million barrels per day. So that in turn means that the U.S. has got excess production of 2.4 million barrels per day, which are basically going overseas, because that's the net imports number is minus 2.4 million barrels per day. I wrote a little piece because I've got a lot of questions about the SPR and what happens when they stop depleting the SPR, though Biden just recently said that he wants to continue to deplete it through December. So I guess he's just trying to influence the gasoline market to get the price down before the midterm elections. He's doing everything he can, obviously, to make people like him and his party. But that's not where I want to go. Let's go to the screen of charts and see if this comes up. I got one question so far. Feel free to ask a few more, or usually I can handle about 5 or 7. So we'll see what I get. Hope you're seeing the screen okay. I double check where we are. Well, as I said, the central bankers all had this 2% inflation target. The U.S., the Fed in the U.S., the ECB and the BOJ and other central banks have been saying that their inflation target is 2%. And as we know,
I didn't understand that.
Oh, somebody's talking to me. It seems like Alexa, not Alexa, but whoever this is here. Okay. So the personal consumption expenditures deflator, as you can see for the US, they have not been able to sustainably get it above 2%. And now with the post-pandemic helicopter money, excessive fiscal and monetary stimulus, they got more than they bargained for with this surge in the headline inflation rate to 6.2, the core to 4.9, well above their 2%. And now, so during this period, they were basically worrying about deflation. They're worrying that they couldn't get it sustainably to 2%, which is how they justified their unconventional ultra easy monetary policies. And now they've had to swing back to what were conventional tight monetary policies, conventional during inflationary periods back in the 1970s. Same goes for the ECB. Of course, they've had a lot of their inflation energy related, and you can see that the headline is 9.9 and the core is 4.8. But they're certainly talking about tightening their monetary policy. I don't know that there's much they can do about the inflationary pressures caused by Ukraine war, but as central bankers, they have to talk the talk about bringing inflation down. And Japan is the outlier, of course. They continue to maintain ultra easy monetary policies, but that everybody's waiting for that to change because the yen has dropped substantially, and that's creating inflationary pressures in Japan, as you can see from this chart. But the main focus really has been on the Fed and the ECB, and really on the Fed. This is probably the #1 ugliest, most bearish chart that is most often shown by bears when they talk about where we're heading, which is not pretty according to them. And as you can see, I mean, anything with an uptrend can be correlated to anything else with an uptrend. But in this case, one can make the argument, they've made the argument, and I don't disagree with it, that ultra easy monetary policies had a lot to do with the bull market that we enjoyed from 2009 to January 3rd of this year. All that liquidity certainly helped to pump up the stock market. This is the Fed's balance sheet, as you can see. It's not a perfect correlation, but the trends are kind of in sync. But now they're saying, look at it now. They are on track, according to QT2. This is QT2 now, to substantially reduce their balance sheet by a couple of $1 trillion by the end of 2024. And that means that you ain't seen nothing yet. There's talk about the market going down 50% from its high. And that, by bearish standards, is pretty moderate. There are people talking about 75% in terms of how much lower this can go, that this is all rigged. And now that the rig is over and the central banks can't provide a put, can't help the market because they've got a serious inflation problem, that this is going a lot lower. I would have you look at this chart, which suggests that, well, if you think of the stock market as two main components, PE times Z, arguably the PE is already discounted quite a bit of the reversal from the great monetary ultra easing to the great monetary reversal with tightening monetary policies, particularly in the US. I mean, clearly it's conceivable and arguable, as bears do, that this thing is we're gonna drop into a severe recession because of all this. And in recessions, the valuation multiple doesn't hold at 15. If it held at 15, it would be a remarkably high level to start the next bull market, and so it's argued. But the argument is that the forward PE in a recessionary environment goes down to where it was back like in 2008, which is more like 8 to 10, which is a substantial drop from here, obviously. But I'm thinking that we're going to have a rolling recession. I'm thinking that inflation is moderating, has peaked, will show more signs of moderating in coming months, certainly on the good side, excluding rent. I think everybody knows that rent is kind of a bizarre component of the inflation measures, the consumption inflation measures. So I'm thinking that the PE we're trying to make a bottom of the market is the bottom line, right around the June 16th low, 3,666. We've gotten below it, we've gotten above it. Looks like we're trying to hold on to that low. And I think if in fact the Fed is going to start is going to do 75 and moderate that by saying that that's it for a while. They're going to pause, see how this all plays out, which would be the prudent, smart thing to do, in my opinion. If they keep going, then they will overdo it. They may actually overdo it with two more rate hikes. But look, that's already in the markets. I mean, mortgage rates, 2-year yields, 10-year yields, they've all discounted 4.5% as the terminal rate. Remember, we're up 300 basis points from March from zero. Another 150 basis points will get us to 450 basis points, 4.5%. As the pause rate, if not the terminal rate. And at a pause rate, even if it's not the terminal rate, I think the market's bottom holds here. And I think we're in a seasonal period where Santa Claus, we can maybe count on Santa Claus to drive this market higher. And Santa Claus does especially well for the markets during midterm elections, following midterm elections. And it doesn't really matter how they play out. Midterm elections have a remarkable record of jump here. You may have seen my work on this. Stock Traders Almanac has done work on this. And as you can see, don't bother asking any more questions, by the way. I got a good list of questions now. But as you can see in figure 8 of this morning's chart collection, you can see that we went back to 1951 in one chart, and then we went back all the way back to 1929. And every 12-month period, with the exception of this one in 1930 and 1938, midterm elections were followed by green shades, which means that we were actually up. So here we're 42.6, here we're 24.3, here only 0.1. This was not a stellar one, so maybe this doesn't really count, or it counts among the reds. But look, 16.2, And then you can look at it on your own. I think most of them are decent. Yeah, they're mostly decent double-digit increases or mid singles. And that's for the 12-month. And then there's some data here on 3 to 6 months. And I think out of the 20 observations since 1942, multiply that by 3 different periods, 3 months, 6 months, 12 months. So out of the 60 periods, there's only 3 where we had a negative sign. So that's pretty compelling stuff. I would imagine that it'd be even more compelling if we actually get a red sweep in the House, and the Republicans only have to pick up 5 seats to own the House, and that would be enough to, I think, pretty radically change the direction of the government, or stymie the administration from moving along the lines that they've been pursuing with massive spending programs described as anti-inflationary. Well, back to the scenario here on the rolling recession. I've explained to you before and now updated why I think it is. But I'm clearly fighting, and maybe that's not very smart to do, leading indicators, which peaked in February, and they're down by like 2.5% through September. And they do have a very good track record of calling recessions. So it is obviously a concern. Meanwhile, the coincident economic indicators keep moving higher. Production is up, employment is up. To really get a recession out of this, the Fed, I think, would have to tighten to the point of really hitting the labor market. And it's the labor market has got a lot of shortages in it, and it's not clear that it's going to be that easy to cool it off. But I think we are starting to see some signs. Maybe employers themselves are concluding that just willy-nilly raising wages is not going to work for them. Increasingly, maybe they're finding it's not that easy to pass it on. And so I think we are going to see some cooling off in wage inflation, which obviously is critically important, more important for services than it is for goods in many ways. But again, there's been talk all year about a recession, maybe even this year. I think we're in a rolling recession, but most people now are talking about a recession next year. And we'll see how that plays out. But usually when you have a recession, everything goes down at the same time. Housing, autos, consumer spending, broadly speaking, capital spending, earnings, all that goes down. As I said, we're already seeing some of the recessionary some recession in some sectors. Meanwhile, looking at the forward earnings of the S&P 500, here's what we're seeing on revenues. Revenues growth, this all-time record high for forward revenues, which is a good coincident indicator of the actual numbers. I can't tell at this point how much of this is moderating inflation versus weakening economic growth. It's probably some combination of both. Looking at forward earnings, I've given you the hedge clause before that analysts aren't good at forecasting recessions. They don't view that as their job. They tend to, forward earnings is not a leading indicators. But you have to come to your own opinion. If you agree with me that we're looking at a rolling recession with flattish earnings, and that's what we're getting so far, and that's what I'll be watching for some signal that something's changing to the downside. Though I think we'll get a lot of other signals in that case. But forward earnings are starting to go down, and it's not because of revenues; it's because profit margins are starting to get squeezed. And again, I think that may actually have a positive impact on moderating wage inflation. Obviously, if you're a worker, you don't want to see your wages moderate. But on the other hand, what's the point of getting a big wage increase if at the same time that's completely offset by higher prices? Let me just finish off the charts here by just pointing out just how restrictive monetary policy has been, which in turn implies that the economy has actually been remarkably resilient. We haven't had a credit crunch. We haven't had anything really substantially break here. Most of the concerns are problems overseas. But if you look at the 41-week change in the Fed funds rate, in other words, the the increase in the Fed funds rate since the beginning of the year when it was 0. So we're up, bang, 300 basis points. And you can see that you have to go back quite a ways to see that kind of increase. But the Fed funds rate has been a lagging indicator. It's, with forward guidance, with the Federal Open Mouth Committee talking about what they're going to do, fixed income markets have gotten ahead of the Fed because they know that's where the Fed is heading. So if we look at the 2-year, it's up 377 basis points over the past 42 weeks. We have more current data. That's why we did it that way. And then the 10-year is up 261 basis points. And again, that's pretty extraordinary increases in a very short period of time at the way things have been going. This is the real killer. This is the mortgage yield. And the mortgage yield's gone up because the 10-year's gone up, but at the same time, because of quantitative tightening too, and the announcement, the assumption that Fed officials want to get out of the mortgage-backed securities business, that the spread between the mortgage yield and the 10 years increased dramatically. And so I think we're in a very significant housing recession. I think we're looking at a free fall in mortgage applications. We're looking at a free fall in housing starts, and it's going to be a big negative, but it's going to hit mostly, I think, in the second half of this year. So we'll see what takes a dive in the first half of next year. Maybe it'll be auto sales, but auto sales aren't exactly booming at 13 million units at an annual rate. So let's see what you folks want to talk about. Brian, Dr. Ed, given the rise of the dollar, its impact on other currencies and their monetary policy, do you think the Fed will consider other countries and possibly slow bond selling? No, I don't think the Fed really pays much attention to or cares much about the international situation. They haven't really mentioned. I don't know that they mentioned the dollar at all as a factor here. The free falls we've seen in the euro and the yen. Again, I don't see any of them making speeches raising that as any sort of issue for us. So they seem to be oblivious to the impact of the dollar on the global economy, and they seem to be oblivious to the impact of QT on mortgage yields and what that's doing in the mortgage market. I mean, they seem very they have blinders on to certain things. When home prices were going up 44% over the 2 years through, I think, earlier this year, they didn't really pay any attention to that. Now, one Fed governor was talking about a mild correction in the housing market. I mean, they seem to somehow, on certain things, be on a different planet. But I try not to be too critical. That's really not my job. I mean, I wrote a couple of books on Fed watching, where I said, as investors, as investment strategists, we need to not get hung up on what the Fed should do and pretend we're running the Fed and criticize them and expect that they're going to listen to us. We need to forecast what they're going to do. And what I think they're going to do is, as I said, 275 basis point hikes, November, December, and then pause. Jim, Ed, how many years supply does the U.S. and the world have in both natural gas and oil? If you're talking about the world, I think we've got plenty of it. The U.S. certainly is sitting on a bunch of it. So I don't think, I have this very primitive theory about fossil fuels. I think they're constantly being manufactured by the planet. I've read somewhere that the core of the Earth is something like 6,000 centigrades. I mean, that's pretty hot. A lot of stuff is melting. A lot of chemicals reactions are occurring, and I have a suspicion that that somehow or other may very well be creating some fossil gases and fossil fuels. But I don't know that we need to go there. Apparently that's kind of viewed as a fringe notion, but then again, it kind of makes sense to me as a fringe thinker. But there's plenty of it. Yolanda, why does China continue the extreme lockdown COVID policies? It seems irrational to their growth. Yolanda, the answer is it's irrational. I mean, it's what autocracies do. I mean, we had some irrational policies when it came to the pandemic, but our lockdowns only lasted two months, and then we backed off from them. They just keep having these rolling lockdowns, which have been disastrous for their economy. They're creating a lot of anger among people, but then again, it's a dictatorship. It's an autocracy. We now have Z for life as running the show, and apparently he makes a lot of these decisions on his own, and he's just surrounded himself with more of his cronies. So the reality is dictatorships, autocracies, centralized decision making. They don't get much useful constructive feedback. When they do, they just kill the people who bring them the constructive feedback, or make them disappear. So it's just stupid. And we saw Russia, the Soviet Union blow up almost literally because of Chernobyl. You may want to see that docudrama again to see an indication of how autocratic regimes are very prone to blowing themselves up. So hopefully this regime will blow itself up. Isaac, have 10-year rates peaked? And if not, how high do you think they can go? I think so, but maybe it's more hope so. The spread between the terminal rate, the 2-year, let's say, which is what I think in the market is a good proxy for what the market thinks the terminal rate is, and it's been raising that terminal rate for quite some time. So just because the market's saying the terminal rate is 4.5%, that's what the 2-year rate is right now. That doesn't mean that we're not going to see it continue to move higher as circumstances change. But I think the pause rate is 4.5%. It might be the terminal rate. And if the pause rate is 4.5%, then subtract 25 to 50 basis points, which has been the yield curve spread between the 2-year and the 10-year, and you get where the bond yield is right now, basically 4 to 4.25%. But clearly, there's still plenty of people thinking that we're going to go to 5% and even higher than that. One of our accounts very astutely predicted when I think the yields were about 3.5, that they're going to go up to 5%. So far he's more getting it right, but he thinks it's going to be 5%, and he said he hopes it doesn't get to 6%. And he's been pretty good at predicting these things. Paul, how much will Ukraine and China zero COVID weigh on the global economy, energy prices? Well, we kind of discussed that, right? I think that the Ukraine situation seems as though it's going to be an ongoing one. Let's not forget, this war really started when Russia took over Crimea, and they've been fighting each other on the east border of Ukraine since 2014. So in many ways, this war's been on for quite some time, and it may very well continue. But I think no matter what happens with Ukraine, the old days where Russia was a dependable supplier of fossil fuels, natural gas, and oil to Europe, that's over. That's kaput, as they say in Germany. And I think everybody's scrambling here on this side of the Atlantic and their side to provide more natural gas, at least to Europe. So I think that aspect continues. The COVID zero is, suddenly they decided that was dumb and that they wanted to use Pfizer and Moderna vaccines. I don't for the life of me know why they're not doing that. They obviously worked here, but maybe it's national pride, and they think that COVID zero is a better alternative than using vaccines that have worked. Whatever, we know that if they suddenly decide that they need to do something more rational, that would probably lead to some upward pressure on commodity prices, copper and oil, for example. But right now, there's not much indication that they're going to ease off on that. I think there was some discussion of easing some of the restrictions. I'll take one more. Steve, with rates rising so quickly, I am increasingly concerned that something will break. Can you elaborate on your quick take on the treasury market? The mortgage market also appears to be under stress. Any concerns there? Yeah, you're right. I mean, I think that because of the great financial crisis, the credit system in our country has been shored up quite well. I wouldn't necessarily say come to the same conclusion for what's going on in Europe or even in China. So I think something is breaking in China. We know that their property developers are not able to make good on their debt obligations, and the government's had to intervene there. So I think China's going through the same. I think they're going through a worse crisis in their housing market than we went through in 2007, 8, 9. But whereas in this country, the authorities decided to let Lehman fail, which really dramatically increased the severity of that crisis. The Chinese government's going to do everything in its power to bail out the situation, but that doesn't mean it's not going to have negative consequences for their economy. Home prices are down. People are no longer viewing homes as a good place to have some of their wealth, even if they buy something and don't rent it in a ghost city. So I think that's changing. And I think Europe's also got its issues because of high energy inflation, because Italy and I mean, people are now, the Economist is comparing the UK to Italy in terms of its political instability and economic weakness. So all that still adds up, in my opinion, to TNEC. There is no alternative country. The US still looks like a place where global investors want to be. But that QuickTakes that I wrote on the Treasury market was just kind of responding to an article in the Wall Street Journal raising some anxiety that with rates up so much, with the Fed being so tight, something could even break in the Treasury market, and the liquidity crisis, if you will, which might force the Fed to do what the Bank of England did, which is kind of postpone QT. I don't think that's going to happen here. And the point of my quick takes was there's a tremendous amount of buying by foreigners in our Treasury market, which should keep the liquidity going. Well, I don't want to go much further than this. I've overstayed my welcome with you. I usually try to keep this to half an hour, but have a great week, and we'll keep you posted with the morning briefings, quick takes, and so on and so forth. All the best.